caregiving, tax planning, retirement. So basically these topics that we would get a lot of questions about. And what we did is we turned them into seminars in person. Obviously, we're in a little bit different time now where the webinar route is the popular way to go. Who knows when things open back up again, if we'll go back to seminars, continue with webinars. People like to a lot of times view these in the comfort of their home or office, or maybe it's a mixture of both of them. I have two of my teammates on, Victoria and John. They're going to help out with some of the coordination. If anyone has questions, you can enter them into the chat box, and we'll periodically, see what we can answer. If we can't answer anything, we'll get back to you and definitely, get an answer to what you're looking for some help with. A little background on myself. So I am an independent financial advisor. Company is Bautis Financial. We're fiduciaries. Been in the financial services industry for 20 years. Wrote a book on retirement fitness called the Retirement Fitness Challenge, and also the host of a podcast where we talk about a lot of things financial. Usually disclosures are kind of italicized at the bottom and sort of hidden, but this one we wanted to make a little bit broader. So we're financial advisors. I'm a financial advisor. We may not be your financial advisor. So if you're going to take any information from this, please consult with your financial professional before making any investment financial decisions. Obviously, if I'm your financial advisor, I'd be happy to talk about any of this stuff on your specific level. So today we're going to talk about the 2020 election, the market review. Obviously, 2020 was about as crazy as we've seen with both the election and the pandemic. We'll look at not just what happened, but also what we can see going ahead, both on the market, the economic side. What are the risks? It's a question I get a lot is, markets are making new highs. Should I continue to invest? But it's not just about investments. We'll also talk about some planning things that may come down the road or things to start looking at in 2021 with everything going on. Okay, so I think that we'll start with the election, and it's probably around November was the #1 question that I got. Obviously in February, March, April, it was more virus driven, but there were so many people that would come and say, well, with the uncertainty of the election, should I do this or should I wait? Or, and my message back was the same about it. And then I also saw it again come the end of December with, okay, it looked like everything worked out after the election with the market, but now we have this Georgia runoff where these 2 Senate seats are up for grabs. And should I then wait more and try and time it when things look better? So I'll talk a little bit about history of how markets have done under different presidential regimes, and what we think we can see going forward with the one that we just saw take place yesterday. But also I'll talk to that, trying to time when things look good, and it's going to be a kind of consistent theme that we'll see with a lot of these investment decisions that we're looking at and thinking about. If you look back at 2020, you looked at we basically shut down a country for a good portion of it. When you look at these numbers of what the S&P did, what the Dow Jones Industrial did, the Russell 2000, technology, it doesn't make sense, right? And it's not, you look at it and it's not really correlated, and it's hard to say, okay, why would these indices be up when the economy was shut down and when things were so bad for a period of time? And we'll talk about why the markets aren't necessarily correlated to what's going on in the economy. A lot of times the markets look ahead and see, does it see an end to what it thinks, or does it see a future path? And I think a lot of that is what happened. And it's going to go back to that theme I was just talking about in the previous slide about trying to time things and really wait until things look better. But if you look at it, the markets did well. I mean, the S&P up 16% is what is a great year just in general. Never mind if you look at what happened in the economy. So we'll talk a little bit about that, about the how does the election throw the uncertainty that was around that, and what might happen going forward, and what how can we turn what happened in 2020 and look at what do we see going forward in 2021. So I think we'll see some themes on the investment side with what they're called just shifts. So you see here the winner was technology in 2020, and it's pretty much been the winner for the past 5 to 10 years. Technology has been great. But one thing we did see after the election was a shift into some of the classification of companies or stocks that are called cyclical or value. And I'll explain what the difference is between those. And then you see the losers or the worst performers were energy and value. And it doesn't mean, you look at energy and you say, oh, it's down 36%. It hasn't done well recently. Does that mean we stay away from it? And there are reasons maybe to stay away from it and reasons not to. And whereas it may be, if you look at the price in that sector, it may be good. So we'll talk a little bit about how maybe taking advantage of some, companies that are on sale. Okay, so themes and lessons from 2020. We had the COVID-19 virus. It caused a bear market. The market was humming along prior to it. Usually bear markets, which are a bear market is defined as a drop of 20%, usually they last 22 months. So the COVID pullback that we saw lasted 33 days. It was the sharpest, quickest, time from start of bear market to out of bear market. Which it's crazy kind of when you look at everything that happened, but you can point to the amount of stimulus that came, the fact that the market was okay, that this wasn't a financial event that caused it, and that's you take those into account, and that's probably the reason why it was so short on the that side. Growth versus value. So growth stocks, think of your Amazons, your Apples, these companies that revenues are growing 50%, 75%. Year over year. Your value stocks are maybe stocks where they're mispriced, where you look at the price that you'd have to pay to buy the stock versus the what the company is doing in terms of revenue, and you think of it as a sale that a store is having, and you're able to get something for cheaper, for less than what it's worth. And I think as I mentioned, we saw that shift from growth to value and cyclicals. And cyclicals are companies that they are popular during different times of the what's going on in the economy. An example of one would be like Nike. So people, as markets are going up, people have discretionary income, they have money to spend, they'll buy shoes, they'll buy clothes from Nike. Whereas a growth like Amazon or some of these tech companies that their revenues are increasing, but their stock prices are also continuing to increase, which means they're expensive to buy, but you're buying that potential future growth. We obviously saw a lot of volatility, especially in February, March, with the markets, which not surprising. Unemployment was obviously as high as we've seen since the Great Depression. But again, we saw, as some of the stimulus went forward, we saw some of the companies rehire. Still a lot of unemployment now, and I think that's going to be one of the themes in 2021 is how do we get the jobs growth back? And then also, I think another positive thing that helped drive some of the market for 2020 was the vaccine. Vaccines, if you look at historically, the development of vaccines, how long they usually take to develop, ours, the one for this virus was developed very quickly. And the market did like that. Because what it did is it said, okay, a vaccine's coming out. It looks like it has a high percentage of being effective. So the market sees an end to the uncertainty of the virus, and it sees a light at the end of the tunnel. And because of that, it still has been going up even towards the later half of 2020 and even into 2021. But we'll start looking at going forward now. So we kind of see what happened. Let's look at what we can predict going forward. And then, my favorite part of all this is, well, what are the risks? How do we hedge against these risks? And what do we see as the risks going forward? So I think right now, a lot of people focus on the election, focus on this tax plan, and we'll talk about that. But I think a lot of it is going to depend on the virus. And how quickly we can get to that light at the end of the tunnel, how quickly do things reopen, and then how quickly can we assess what the damage was done from 2020 and how quickly we can recover from that. So, I think what's being thrown out is that the first half of this year, while the vaccine is rolling out, things are going to ramp up, but I think the market is predicting that in the second half, things are going to get back to normal. And that's, that when I use that a lot, I'll say the market is predicting, because that's what drives the market forward. It's what's called a leading indicator. So the market is making assumptions on what it thinks is going to happen. In this case, with the virus, it made an assumption on the presidential election. And when markets go up or down, or they make jumps where people don't expect them to, it's when something happens that the market didn't expect it to happen. Example, let's say the vaccine rollout doesn't take the first half of the year. It goes into 2022 or longer than that. The market may not like that, and because it is expecting that things are going to get closer to back to normal in the second half of this year. So the market's always predicting what it thinks will happen, and that is for some of these high level things like the virus, the vaccine, but also it does it for each company. Everyone knows that Amazon is everyone's buying stuff on Amazon. It prices that into Amazon's stock price. What would happen is if Amazon had a quarter where instead of its revenue of $1 billion, it was 999 million, the market might not like that and drop Amazon's stock price a lot. So a lot of, and that's what I think it's hard to conceptualize, is that a lot of what everyone thinks, okay, this is going to happen in the future, the market prices that already into the stock prices. So it's not so much what's Amazon going to do, or what's this stock, or what's the economy going to do. It's what's the change, what was it expecting, and what actually happened. And that's what time drives a lot of these runs up or runs down that we see. So Goldman released some key risks that they see. The first one is, I think that's an important one, is we don't know what the damage was. Is there going to be shifts in some of these industries where they're not going to go back to normal, or not just shifts in industries, but shifts in the way people work or where people work, or are some of the companies that didn't make it, are they going to come back, or is there going to be a shift where the way we utilize travel or hospitality, or any of these things in terms of different sectors. And I think that's a lot of the unknown. And one thing that the market doesn't like is it doesn't like that uncertainty or unknown. So I think that's why that's showing up as a risk. And then the second one with investor risk, that sentiment, that's the one I talked about, where the market is predicting that things will get back to normal, and so are the investors are predicting that. But there's been part of the reason why 2020 was a decent year or a good year for the market is that there was an unprecedented amount of government or stimulus that happened, and because of that, it basically put a floor at where the economy and where the market would go. And I think the market is expecting more of that. And not to jump ahead into the presidential election thing, but a lot of people prior to the election, even after the election, were worried, well, what if there's President Biden's elected and there's a tax increase and this, and yeah, that's all things to look at and to consider. But I think the market also looked at it as there may be additional stimulus that comes, and the market's craving that stimulus, like basically it seems like a drug addict, where they want it, they need it, and if it doesn't come, that's where we might see a pullback in there. With that, that federal stimulus that's going on, inflation's another key thing to watch, because as trillions of dollars is going out into the economy and to help with all these relief packages, that drives up inflation a lot. And just think of it, you have many dollars competing for the same thing. It's just going to increase the price of it. Now, a lot of times what the federal government will do is they'll raise interest rates to control inflation. However, it's kind of a dangerous game that they would have to play if they had to raise interest rates right now, if inflation did pick up. Now, the Fed's committed to not raising interest rates for a period of time, and I'm sure we're in a low interest rate world for a while. But if inflation does increase, that could change things on their side as they try and control inflation. we basically haven't had any inflation for a while. If that comes into play, that's another game changer, because now people have gone through a pandemic, may have had changes with their jobs, and now things are starting to cost more money. It's everything from the rent to food to gas to tuition. Everything would increase, and then that could present a problem. And then the labor markets. I think the market is predicting that the unemployment was at record lows prior, hit record highs, and it's starting to come back to a middle ground. But if you look at it now, there's still a lot of people that are unemployed, furloughed, and there's uncertainty on their do those jobs eventually come back. China's kind of been on the back burner. I think in 2019. Start of 2020, it was this trade war that we had with China was a popular topic, and obviously it disappeared during the virus. And with the new presidential administration in place, it may come back in a different realm, but it's still there. So I think that's definitely something that is going to play out over time. But it's definitely one. This one went from prior to the virus, this was the number one thing that people were worried about, was this trade war that was going on. And it didn't just, it went away for temporarily, but I think it's still there and still things that need to be worked out. The Fed, it's, that stimulus that they put through was unprecedented. There was just another relief package that came out at the end of December. And already President Biden's proposing another, third relief package on top of that. And I think, these relief packages are hitting different areas of different things that, different areas that need help. Some were focused on the travel, hospitality industry. Some were focused on some small businesses. Some with the unemployment are just focused on people that need it, were not working. One area that you don't hear too much about, but is definitely one that is a risk or concern, is that state and local government level. So unlike the federal government, which can basically print money, the federal and the state and local governments, they can tax, but not to the extent that the Fed can. So they are, and if you've listened to any of it, the news coming out, they're asking for money. It seems more likely they're going to get some now, but a lot of these states and local governments aren't in the best shape. So again, it's another thing that we're keeping a look on, and it's not just there's state and government workers at the local level that are impacted. Potentially their pensions are impacted. There's also investors who invest in municipal bonds that may be impacted as well. So that's just an area that we're looking at. I think that the summary of this is, when it comes to the election, a lot of people did, try and time it and say, all right, I'm going to hold off on investing. I'm going to wait till the election. And what we saw was from the November 6th election day to yesterday, to the inauguration day, the markets were up the most in that period of time that they ever were in any other election since, I think it was like 1928 or 1930. And then if we're going to look historically about how markets have done under different presidential administrations, and I go over this a lot with people, and it's surprising because some people take their political views and try and translate that, whether it's either side, and try and translate that to the markets are going to do better under this president or do better under this president. And looking back at data, and it's not just the presidential administration, because you also have to look at who's controlling the Senate, who's controlling the House, and you look at it as, is it one party across all three, or is it split? And that's even, I think, surprising, where people think that, okay, if it's split, it's even better because there'll be little chance for a president and whatever side the president is on to really pass kind of an extreme agenda. And what we've seen is that when one party controls all three, the markets have actually done better. I think in this case, the market did like the fact that the control over the House and the Senate is not a widespread control. I know, like, the Senate's 50-50, and with the tiebreaker, it is technically controlled by the Democrats. But I think it will keep some of the potential changes in check, just because, some of the senators may be, partying with Democrats or partying Republicans, but their constituents may be moderate, and they don't want necessarily, whether it's an extreme change to it. So, if we look at this year by year, and what this is showing is, who controlled the Senate, who controlled the presidency, and who controlled the House, how the market's done over that. So if you see in the middle, you see divided government, the markets are on average up 11.48%, but if one party controls, it's up almost 15%. So, again, going back to that theme of that, I don't think what happens in 2021, it's not going to be affected as much with what happens politically, but more so on the virus, the economy, and how these companies are doing based on that. Yeah, I mean, this, I like to say, if we look back at 2008, 2009, where it was the last big financial crisis, and since then we started into this, call it this financial experiment that we're in, where there's so much stimulus that's happening, and we don't know exactly what the end game of this is. It's not, there's a bullet point in there. If you look, it says we have to pay for all this spending, and raising taxes is the most obvious way to do it. It's not exactly true. There's the way the government works, and as the government is increasing its revenues that it's generating, and the companies are increasing, the GDP is increasing. It doesn't necessarily mean that if we spend $1, we have to raise $1 in taxes. But I think that's going to be one of the themes that we're going to see going forward, is that, there's going to be some of these bills are going to be due, and the natural way to pay for it is raising taxes. So we'll talk a little bit about what raising taxes mean, and what does that mean in terms of planning, or anything like that. I'll take a quick stop. Victoria, do we have any questions?
No questions as of now. So
okay.
If it has one right now, feel free to put it in chat.
Okay. So the other question I get, another frequent question I get is, well, what happens with what's going to happen if President Biden's tax proposal goes through? If is it going to cripple the economy if we have a weak economy, plus this tax plan that's going to raise taxes? Is that going to be like the nail in the coffin that really puts a drop in the economy? And I think some of the things that are being proposed now is a lot of these changes happened in 2017 with the Tax Cuts and Jobs Act, where some of the tax brackets were reduced. Corporate taxes that the corporations pay was reduced a little bit. There were some changes to the estate planning. Some of these are in proposals to change. Basically a return up to the 39.6 tax rate on anyone that has income over 400,000. Corporations would have to pay more in tax. I'll talk a little about the estate tax or estate planning. That estate planning has taken a little bit of a back seat for a lot of people, because the exemptions were raised up to 11.58 million per person. And if you coordinate it with a spouse, you can look at over 23 million that your estate would have to be before you would get hit with any kind of estate tax. That may change. That the proposals are that it goes down to 3.5 million or 5 million. And if you start adding up someone's assets, you can hit that pretty quickly. And then the step up in basis is one thing that's a really good tool that we utilize a lot. Is if someone inherits an asset, the price that asset was called the cost basis. When someone passes away, it gets stepped up to whatever the value is at the time that they died. So even though they may have purchased a house in 1950 or 1960 at $50,000, and it's worth $500,000 right now, if the person that inherits it sells it, they wouldn't have to pay tax on the capital gains tax on it. That's the way it works now. And I think one of the proposals is to abolish that step up in basis, so that if the person that inherits it, they would have to pay tax on $450,000 of capital gains. So that's what they would sell it at with the current market when they inherited it, minus what it was paid for back in 1950. So I think they're, and these are tax proposals that are proposed now, which may potentially go into place. But even if these don't get passed, or some of them don't get passed, the current ones that were passed in 2017, they're set to expire in 2025. So we're all going to have to start doing, or we should all start doing tax planning, now, in preparation of at least that, but also some of these which may go through. And there's different things to look at, in terms of how to protect or hedge against some of these proposals that are in place. A couple of those are Roth conversions, which I'll talk about. One of my favorite things going into 2021 that I want to look at, harvesting gains, which means you're paying the tax now at a capital gains rate, because what the proposal is potentially that capital gains rates might increase or go to ordinary income rates, which, like we saw, those can go as high as 39.5%, whereas capital gains rates right now are as high as 20%. So it's kind of a balance act where you have to look at how much gain is in a particular asset that you have. Does it make sense to pay the tax now? And which is called that harvesting. Another popular thing is harvesting tax losses. So that means, at the end of the year, we look at, okay, I have this much in this asset or the stock I have has had a loss. We can sell it and we can take a tax loss on it. Going forward, it may make sense to delay doing that because the loss may be at a higher, you can deduct it at a higher tax rate than if you did sell it now. But like I said, either way, it makes sense to look at the specifics and kind of game plan off of that and say, all right, the plan is we're going to leave this asset, not sell it, but we may sell this to harvest the gain on here, but we're going to keep the loss, which is kind of contradictory to kind of the thinking in a lot of cases that has been previously. All right, so we're going to talk a little bit about why planning is going to be a little bit complicated now versus how it's been. Obviously, we have the presidential election, and potentially is a gridlock government. We don't exactly know what can get passed or what is going to get tried to get passed. There's been a lot of legislation that's come out. So in the past 3 years, we've had the Secure Act, the CARES Act, and the Tax Cuts and Jobs Act. All three of those have been enormous bills that have really rewritten a lot of retirement planning, tax planning, that we need to look at and decide whether someone needs to take action or not on it. Next, historically low interest rates. I think, the number two question that I've gotten over the past year, with number one being, about the election and about investing at highs, is I have money sitting in a bank account earning, and it's some paltry interest rate that they're getting. Should I be doing something different with it, or is there something different I can do? And the way I answer that is yes, there always is, but you have to make it as an apples to apples comparison as possible. And usually, you look at the bank and you look at some FDIC insured savings account, CD, and the way I approach it is saying, yeah, we can get a higher interest rate, but it means that we're going to take on additional risk to do it. And we have to look at, is the risk worth it to take? Is someone comfortable with risk, and does the risk make sense? So that's how I approach that. And again, it's a specific, everyone's different in what they're trying to do with it. And then the last thing on here is like we talked about, the tax rates are historically low. They're probably going up in the future. Just like, I've been saying interest rates are probably going up in the future. It's taken a lot longer to get there. We may see tax rates increase a little bit quicker than we've seen interest rates go up. I mean, interest rates have gone down over the past couple of years. So in terms of the planning side, I think 6 things to focus on, and we'll go through each of these, is how is your portfolio allocated? I think we all there was a gut punch in March, and you really have to look at how did you handle that? Did you sell and say, I can't take what's going on. I want to wait until the coast is clear, which may mean that you were allocated too aggressively. Or was it, it was bad and there was a big market drop, but was it, something that you were able to handle and able to stick out and wait out? I think one common thing that I did see back in March were people saying, this time is different. I can't take it. I don't want to take it. This time is different. And, if you look back over the years, we've seen all these indications where some bad news came out and we thought to ourselves, this time's different. The market's not going to come back from this, and things are going to change. And I think one of the lessons we learned is that, it wasn't different in 2021. And it doesn't mean we're not going to see a pullback and we won't see a future pullback. But, the market did recover, and, the market probably will recover from any future pullbacks that we see. The 3 through 6 is really looking at specifically retirement planning, estate planning, just general planning, and also how distribution planning is coming back into play too. It's, we've saved all these assets up. How can I be most tax efficient? Look at the returns I'm getting when I start taking money from these accounts. And does it make sense to pull money from my taxable account first, or should I start pulling money from my IRA because I know that tax rates might go up in the future, and I'm gonna have to pull money out at a higher tax bracket or tax rate. So the first thing, we'll talk a little about the asset allocation that someone makes. And I think one way to start is, where do you have your money and what are the taxable implications of where the funds are? If you have it in a traditional IRA or 401k, you're getting that tax deduction up front, and it's great to get that. But you're eventually going to have to pay tax on it in the future. So you have to look at, run a projection and say, well, I'm pulling money out at this rate, I'm getting the deduction at this rate. It makes sense to continue doing that. And I've brought up the Roth IRA earlier. It's something that I bring up a lot because it takes the tax brackets or tax increases out of the equation. You put post-tax money into a Roth IRA or a Roth 401k, and as long as you take it out when you hit a certain age, or there's a couple of other ways that you're able to take money out, you don't have to pay tax on the money coming out. So that if there's $1 million in your Roth 401k or $1 million in your Roth IRA, you can plan for that and say, okay, I'm going to be able to pull out at least $1 million from there. Whereas your traditional IRAs, where you're getting that deduction each year, a lot of people don't realize that they have a partner in that, and their partner is the IRS. So every time you take money out, as you're, if you stop working, you're retiring, you're taking money out, part of that is going to have to be paid as ordinary income taxes to the IRS. Roth IRAs also have a benefit in that they help with estate planning. They're another way of transitioning accounts or assets to beneficiaries. And because they've been paid with pre-tax money, you have a little more access to the money prior to age 59 and a half. And then the taxable accounts are another option, a way to save money. And you can be as conservative or be as aggressive as you want in them. The only difference is you have that flexibility of using these accounts liquid. You can use them at any time, but you're going to get a 1099 each year that shows this is the interest, these are the capital gains, and you're going to owe tax on that. And one, I guess, visual is to look at the different types of allocations where you can add your funds to. And we like to bucket this approach, and it's not that one is better than the other, but for example, in the middle you see the tax exempt interest, and these are the municipal bonds that I was talking about. A lot of times retirees like these because they're typically, the state and local governments are pretty stable. They do, they can raise property tax or they have other taxing abilities, or if it's another type of municipal bond, it's based off of revenue, and the interest is exempt. So again, back to that Roth IRA type where you don't have to worry about paying tax on it. But also, I do like a lot of times we'll throw dividend stocks into there. Just because the dividends are at a preferred or a lower tax rate that you'd have to pay than interest on a bond or interest from a rental real estate property. I think going back to a Goldman study where they're looking at the outlook for bonds not so good, or the outlook, and bonds can be across a couple of different things, whether it's treasury bonds, whether it's corporate bonds, or whether it's state and local bonds. And the reason why they have that it's such a poor outlook is that the interest rates are so low right now, they can only essentially go up in the future. And when interest rates go up, it has a negative correlation to, or adverse correlation to, the price of the bond. So there are ways to not be affected by this by holding a bond to maturity or holding a CD to maturity. But it's like I said, planning is going to change in the future. It used to be 10, 15 years ago, you could buy a bond and it would kick off 7, 8, 9% interest. Now you buy a bond and it's producing 2%, 3%, and you're taking on the risk of potentially of interest rates going up. So again, it's something that we need to look at and see, does this particular bond, and they come in many different flavors, make sense for what you're trying to do. I think some asset allocation themes to look at are, a lot of people look at risk, and I use risk a lot when I talk with people, and they look at it as one of those 4-letter words. It's a dirty word, but in some cases now it's essential. You look at how much risk does someone need to take, and in some cases we need to take risk to be able to get the growth that is needed or wanted in those accounts. So you want to look at, how do I still get growth in the account while maintaining the right level of risk? The recovery trade is another thing, a popular question that I've gotten, and I've gotten this throughout, the past year. But it's all right. At what point does it make sense to invest in airlines or some of the industries that were really hit hard? And it goes back to the depends and understanding what the risk is in that particular investment. And then the other thing, which I'll talk about in a little bit, is what's called alpha strategies, which is how to gain a better return while maintaining the same risk, or maintain the same return while taking on less risk. So that's part of it that how we try and approach it, is really look at, from a risk perspective, how can we obtain alpha, which is that outperformance, while maintaining the same risk, or if we have the right amount of risk, or if we have the right return that we're targeting, how can we do it while taking on less risk with the portfolio? So again, growth, like I said, is low interest. Sometimes an investment that's typical for growth is the right investment to have in there, and they shouldn't necessarily be shunned or shied away. The recovery stocks, as the economy does recover, there are certain types of companies that do perform better. They're small companies generally do better, as do mid companies. Foreign emerging markets and have kind of become an afterthought over the past 10 years, just because U.S. large cap, the companies we always hear about, the Apples, the Disneys, the Amazons, the Microsofts, have really done well, but that's not always the case. And some of the foreign economies are in better shape than ours is, and we may look at, there may be a better return going forward from some of those countries than there is that we see in our side. And then there's other types of investments. Everyone thinks, all right, I need to invest in the S&P 500 or these US large cap stocks, but there's a lot of different investments out there that, the investment world is always evolving over time. And I think there's been access to a lot of these investments over time that we all have the ability to invest in now. Some of them don't make sense, but a lot of them do. And as far as constructing a portfolio, they can help reduce the risk or hedge against taxes, or provide the necessary income. And just like anything, we should look at them and consider them as potential additions to a portfolio. I like to pull this slide up because a lot of people will say, well, should I just invest in the S&P 500 and call it a day and everything will be fine? And it may over time be fine. But the S&P 500 does go through periods of time where it doesn't do anything. And the time slot that I show to illustrate that is between 2000 and 2009. So if we take those 10 years, that's called the S&P 500's lost decade, because it actually started out in 2000 higher than it ended in 2009. But if you did invest it but other types of investments actually did well over that period of time. If you just invested in foreign stocks, they were up 17% over that period of time. If you just invested in small cap stocks, so these are the smaller companies, they were up 41%. If you had a diversified portfolio across a bunch of different ones, it was up 52. And even these stodgy bonds that people don't like and shun, they were up 85% over that period of time. And then emerging markets was the big winner, where they were up 162%, or I think it was 12% per year. Over those 10 years that they were up. So, diversified a lot of times is better than one asset class. But also we should be looking at just different things than just that straight, okay, I'm just going to invest in US large cap stocks. All right, I guess I don't know what number I'm at with in terms of frequency of questions, but Bitcoin is up there. And I'm not going to go into what Bitcoin is because I think there definitely is some questions about that people have on that. But the question I get is, should I be investing in Bitcoin? And a lot of times the question comes from, well, I'm seeing it in the news that Bitcoin, and if you look at this chart, you see that big stick that goes up towards the end of it. That's the price of Bitcoin going up 400% in 2020. So the questions come naturally with that FOMO, or that fear of missing out. Am I missing out by not investing in Bitcoin? And I've never really gone out to someone and said, invest in Bitcoin, invest in Bitcoin. What I've done when I got that question is look at the pros and cons and how would it fit into what they're trying to do, and making sure that they understand the risks of it. And the first way I understand the risk is, if you look in the chart, you see 2018, Bitcoin was up at 18,000. The price of Bitcoin was 18,000. Over that year, from 2018 to 2019, it went down to 3,000. So that's it's a mammoth drop that it had in that period of time. And what I do say is, what would happen if Bitcoin dropped 80% from where it is right now? Would you be okay with that? And that's one way to kind of just have the investor visualize what potentially could happen. Yeah, it went up, it spiked up. And this goes the same for, investing in other companies that have had really quick, really high gains, like Tesla's another example, or some of these IPOs that have come out. And my approach to answering the question has always been the same. There are some positives about Bitcoin, and I think the number one reason why it's getting a lot of traction now is we're all seeing the stimulus that's going out there, and the government just printing money. There are a finite number of coins that are out there, and I think people look at it as, well, it's going to hold its value. It's similar. It's like you can equate it to a digital version of gold, where people look at gold and they say gold's an inflation hedge. It's a hedge against a weakening dollar, and that's what we might see. The dollar, because all this stimulus goes out, the dollar may weaken, which may have other impact to the economy and to the markets. And people look at Bitcoin and say, well, they're not producing, they're mining for them, but there's not additional ones that are being created. And it's a better way to hold value than, in something that's valued in dollars. It's also getting more traction and usage. So if you look at it, you're seeing it being accepted more. And I think that was one of the things back in 2018 that people were worried about. It sounded great, sounded cool. It's a thing that the government doesn't have control over. I think that will change eventually in the future. But it wasn't accepted anywhere. You couldn't do anything with it, really, aside from hold it. Now I think we're seeing more usage of it. People are buying houses in Bitcoin. It's being accepted a lot, and you're seeing some of the financial institutions start to accept it as well. On the con side of things, and this is what I always say is, Bitcoin, I think right now it's down to like 32,000, but what's the value? How do you value Bitcoin? If we're valuing a stock, if we're valuing a piece of real estate, we can look at the cash flows, we can look at the earnings or the revenue that it's generating, and we can generally put a value on it. How do you value what is the right price for a Bitcoin? And that's, I think, one of the challenges of Bitcoin. The other thing is, yeah, it sounds great. It lives on this blockchain technology. It could hedge against some monetary and economic policy. But what if something better comes along, and all of a sudden, Bitcoin just loses all its traction? Everyone goes to this new type of coin. I know there have been additional coins, and it looks like Bitcoin has some staying power, but there's always a chance that something new comes and Bitcoin just gets pushed to the side. So now, how do you hedge against that? With a new coin that looks like it's getting traction comes out, do you allocate some of the money to that? So, I think the way to approach it is look and see how it fits into what you're trying to do. Look at the pros, look at the cons, understand the risk, understand what you could see in terms of price increase, price decrease, and from there make a decision whether to include it or not include it in your portfolio. I think I mentioned earlier that tax planning is going to be critical. Managing the tax brackets are extremely important. You're at one tax bracket, and you have to look at, well, if I take future or any additional deductions, can I get to a lower tax bracket, or vice versa? Can I accelerate any income? And Roth conversions are a big part of this. and stay within my tax bracket. And that's, one thing that's going to be a popular theme in 2021 is looking at, how to manage those tax brackets over time. The other thing I talked about was the capital gains planning, and it's sort of being flipped on its side now, where you want to harvest tax losses and defer tax capital gains. It's almost being looked at reverse, starting now, where it may make sense to harvest some of the gains now and pay the gains at a lower tax rate than you would if you waited until the future. Real quick, I'll talk about some of the retirement plannings, but and again, Roth conversions take into this account. But some of the other things we talked about with the Secure Act has changed the way beneficiaries can inherit and stretch IRAs. It used to be that someone would be able to inherit an IRA, spread it out over their lifetime. So if someone was in their 40s or 30s or even younger, they can really spread that IRA out over a long period of time. It was a great tool. Now that law has changed as part of the Secure Act, and it has to be depleted. The inherited IRA has to be depleted within a 10-year period of time. But there are some specifics on how that has to be set up to be able to take advantage of that. If it's not, it gets depleted would have to get depleted over a 5-year period of time, which obviously is less advantageous to having this IRA, which is in this tax advantageous umbrella to utilize. So there is some planning that has to go on the retirement side as well. I think the main thing, it's not obviously contributing to retirement accounts is a good thing on multiple levels. But I think if you look at the bottom to the HSA, which is a health savings account, it's a tax advantage account that you're able to contribute to on a specific type of health insurance plan. And I think not as many people are taking advantage of this as have the ability to, but I'm a huge proponent of HSAs because unlike pretty much anything else, they have the triple tax benefit. So not only do you get a deduction for money that you put in to the HSA, but you also don't have to pay tax on it coming out. With all these 401ks and Roth IRAs, you either pay tax at the beginning and you either get the deduction at the beginning, pay tax at the end, or contribute with post-tax money and don't have to pay tax at the end. You get the tax benefit at one or the other. The HSA, you get it on both sides. So the money does have to be used for medical expenses, but it's it can pretty much cover almost every medical expense, and it's a great way to save for medical expenses in retirement. So I'm a proponent of, when applicable, to take advantage of HSA accounts. I mentioned this earlier about estate planning, where it did get put on the back burner for a little bit because the state tax exemptions were so high. That's not going to happen in the future. They're set to sunset in 2025, but also we could see some tax changes going forward now. If they can get some kind of bipartisan bill across, that may change the estate planning going forward. So you want to look at how assets are titled. Does it make sense to change the titling of assets, put them in trusts? Gifting is a big thing, where we're all able to gift up to $15,000 a year to any one person. So a lot of times people will put a year-by-year gifting strategy in place, and what that does is that's a way to transition assets to another generation without having any tax consequence by doing it. And then, like I said, the Secure Act actually did have a lot of changes to estate planning as well. And it definitely warrants looking at how those specific changes will impact you, whether it's beneficiaries, some of the ways that life insurance could be utilized, and then also that distribution planning in the order of how you start withdrawing from your accounts in retirement. And that's what I have up now is distribution planning. And that really encompasses, I have all these assets. I have an IRA, I have a Roth IRA, I have a savings account, I have a taxable investment account, I have this real estate property, I have maybe this life insurance policy. How do you look at all those different assets and the right order to start pulling money, pulling money out of those? And then in addition to that, does it make sense to convert? And it doesn't have to be converted all at once, any of those IRAs over to Roth IRAs or Roth 401ks for the benefits that we talked about earlier on that. And this is just, I talked a little bit about that tax bracket management or tax bracket strategy. This is just a quick slide that shows how someone's in one tax bracket and how they can convert some of their IRA over to a Roth and still maintain that tax bracket they're in, not bump themselves up into a higher tax bracket. So I've started looking at or implementing these with some people, and it makes sense to look at your specific, someone specific, where they are in the tax bracket, how much do they have before they get bumped up to the higher tax bracket, and then taking those two pieces of information and deciding whether it makes sense to convert any of an IRA into a Roth. And I think it doesn't, it's, people will say, oh, I'm retirement planning now, maybe I'll do that, as I approach retirement. The younger someone starts looking at these Roth conversions, the better, because once you convert it into a Roth, you don't have to worry about taxes again. If someone says they're going to convert $10,000 today into the Roth, but next year it's worth, and they don't do it, and next year it's worth $12,000, if they converted, they'd have to pay income on $12,000 versus a year ago, they'd only have to pay it on $10,000. So the timing of it is also obviously important of it as well. So, a couple of key takeaways: don't base your plan, your investments off of politics. I think we've looked at historically, I don't think anything's going to change in this administration in terms of it would have made sense to wait 4 years or, wait until the next administration. I think in 2 years, there's going to be another elections really focusing on, I think, about 34 Senate seats. I think that'll be important because right now it is, it's 50-50 plus the tiebreaker. If we see it sway one side or the other, I think, that can change things. The 60-40 portfolio, it was a common way to invest. And I think it was one of these set it and forget it types of investments. And, I think the theme is going forward, be a little more cognizant of what's going on in your portfolio, what's it invested in, and are there any opportunities to, take advantage of a lot of this volatility or a lot of uncertainty that's going on with the market. So this is just a rehash of what we talked about, where, looking at your portfolio, understanding the need for tax planning, and that, retirement, estate planning, and general planning, it's not just do it as you're older, as you're approaching retirement or in retirement. The earlier you do some of this stuff and the earlier you look at it, the better off you'll be long-term for it. So these are just some of the sources that we used. Like I said, I'd be happy to talk to anyone about the info in this webinar. This is a link. Victoria will also put a link in the chat box if you want. You can also go to the website bautisfinancial.com, and there's a link there where you can schedule a meeting. And like I said, I'm happy to talk, someone's specific situation, specific questions they do have. And Victoria, have we had any questions come up since?
Yes, we do have two. So the first one is going back to when you were talking about timing the market.
Mm-hmm.
And the question is there ever a situation where you might time the market, or are you against market timing in all circumstances?
Sure. So, I mean, for the most part, I'm not a market timer. I think some of the strategies kind of, hinge a little bit into timing. I mean, like if you look at it from just its really strict definition, passive investing is just taking, some kind of index like the S&P 500 or the Russell 2000 and just putting money in there and just leaving it. I think there is some to timing the market when it comes to, dollar cost averaging, which is, putting money continuously into the market. I've been a proponent of buy things on dips. If there is a dip, if someone has money that they're looking to invest and there is a dip, it's very hard because emotionally you look at the market go down and it's counterintuitive to what a lot of people think. A lot of people think it's just going to keep going down. But what I've implemented some strategies with people where if the market takes a dip of X percent, we're just automatically going to buy. And technically that's a market timing strategy in itself. I've also been a proponent of rebalancing, which is not market timing, but it is not the passive approach where it's, we have this risk strategy in place and, allocating it and changing the allocation when it sways from that, strategy that we put into place. So I'm not, I'm very much against, the call I'll get where, it'll go something like things don't look good, I want to take all my money out on the sidelines. And when things look better, I'll invest. And, that I'm not a proponent of, because a lot of times that it's impossible to time it, because you have to time it correctly on both sides. You have to time it when you're taking the money out, and you have to time it when you're putting the money back in. And it's really challenging to get that right.
Okay, great. And then the next question we have is, if Biden's tax plan occurs and tax laws change, is the government obligated to give us a fair warning, or could decisions we've made based on the previous tax laws possibly get affected?
So I'm laughing because the answer is no. The government doesn't have to give any fair warning. And not only that, they can retroactively make things, so like, for example, if something, if a new tax law got passed towards the end of this year, they can retroactive it to January. So someone may have been making decisions based off of what they know now, and that could change, based off of what actually happens, even though it's in the same tax year. I don't think we would say, people file their taxes for 2020, and next year or a couple years down the road, there's some retroactive tax law that gets passed where people would have to go and redo all their tax returns. But definitely in the same year, they could go back and I think the goal is to give fair warning. I think they do on some stuff, but no, they're not required to do that.
Okay, great.
Okay,
that's
perfect.
for the questions then, unless anyone else has something last minute they want to put in the chat.
Okay, so thank you everyone for attending. Like I said, Victoria will put our link to set up our calendar meeting. We're going to be doing more of these in the future, so look out for some additional invitations. If anyone has a specific topic that they'd like that they think would be a good topic for a webinar, obviously we'd love to hear that. We'd love getting feedback on what people think are important, or people have questions about. So thanks again, and like I said, a replay of this will be going out.